Welcome to The Landscape, George Smith Partners podcast. Welcome, everyone, to The Landscape. This is George Smith Partners podcast. I'm Evan Kinney, and I'm with my co-host, Mr. David Pascal.
Hello, everyone. Glad to have you this week.
And today, our special guest is Mr. Robert Wasmund. Robert is the CEO of Ascent Developer Solutions. Robert, why don't you give a little bit of background on yourself and tell us who you are and kind of how you got here?
Hey, really appreciate you guys having me on. Robert Wasmund, founder and CEO of Ascent Developer Solutions. Long story, circuitous route. I was the co-founder of Anchor Loans. We started that company in 98 until 2012. So I spent arguably 12 years at Anchor. The interesting part of that, and I'll just briefly touch on, is the fact that Anchor operated both equity and debt. 80% of our business was debt, 20% equity, things like small subdivisions, small multifamily aggregation, anything opportunistically that made sense from an equity perspective. And part of the reason that's important is that internally, like be able to develop internal capable construction management solutions internal to the company, super important on the equity operator side, as well as evaluation. So I think given that we built those that infrastructure and those tentacles for that, we were just better positioned when the downturn came. So in 2008, the GFC, 2009-10, it was a very interesting time. We lost 40% of value and 50% of our book went into default. For me, it was a light bulb went on, aha moment where, half our book was mom and pops, lighter on liquidity, that we really had 10 years of high yielding performing book at the end of the day that really just had to turn in the keys because they didn't have liquidity to be able to withstand the issue. And the other half of the book was seasoned veteran developers, deeper in liquidity, deeper in track record. And that became my prospective business. So after 2 years of pain and working out on the servicing side of the portfolio, my view was there was a way to attack and build a national private lending company, bring in real institutional capital and back lever it, and create a professionalized private lender that would compete with regional banks. So that was my vision coming out of that 10 years of body work with Anchor. And that was the birth of Genesis Capital. So I had a pretty sizable book. I had a lot of talent at Anchor that I had spent 10 years with already. And I took the book and the idea I had and the talent and pitched Oak Tree Capital that there's really an opportunity to build a national private lender that had never been done before. So Oak Tree gave me the company the first $250 million equity check that we back levered with Deutsche Bank and Wells Fargo to create Genesis Capital. We spent 4 years there building out a national presence, 75 full-time employees, $2 billion in origination, building that out with just bankable sponsors, mostly that were funded prior to with the regional banks around the country. Very successful endeavor. Oak Tree, we woke up in 2017 and said, hey, we're going to take the company from 75 full-time employees to 200 and to build the $2 billion book to $5 or $6 billion. We really needed an investor that was going to invest in technology, talent, human capital to take that next leg of the journey. And so we went to market in 2017 and sold to Goldman Sachs. Goldman Sachs won the bid. They liked the fact that we were dealing with bankable sponsors. I think it was another first in the industry where we took a private lender and put it into a regulated balance sheet. Cost me a few years of my life at the end of the day, but built robust credit capability, governance, compliance. And that was really the next step and phase from 2018 through 2021 of building Genesis Capital. Spent 3 years that, then opportunistically in 2021, again, a situation arose where we could sell the company for high profit. And we sold the company to New Residential, which is now Rhythm, at the end of 2021. Separated from Genesis in 2023. And decided, given the retraction of regional banks like First Republic and Signature, to actually capitalize the company myself and go back to the market in 2024 for an equity raise to restart Ascent Developer Solutions. So I spent 2024, I raised $500 million in equity capital from Elliott Capital Management. They're a $70 billion private equity company. So confident that we're the largest balance sheet in the industry. Key to note that we balance sheet all of our loans, retain all servicing, which is really important for customer value, response time at the end of the day. And again, doubling down on continuing to build our data first approach, construction management services capability in-house, and evaluation capability and apply that on a national basis. We've been closed we announced that deal in Bloomberg in July. We're 6 months in. We'll fund $1.5 billion this year. We funded $500 million over the first 4 months, so it's a great start. But the reason why it's a great start is I had 200 to 300 sponsors that were all bankable that we provided value to for 10 years. So a seasoned, sophisticated book of business is a starting point. In addition, many of the folks that I had built a company with and had 2 trades with came along with. So today we're 65 full-time employees, going to 85 this year. And most all of the execs that I had worked with through a couple different evolutions, as well as the borrowers and sponsors I had done business with, have come along for the ride. So it's really been a great start for Ascent this year.
That's amazing.
Great to hear.
Great backstory, and just, super impressive to go from 0 to 70 people and 1.5 billion in originations in just a few months. So sort of a testament to all the work you did before that, right?
Well, I think Elliot did the deal because even though we were a de novo start, it was really just capital starved environment, of talent, exec talent and book of business that just needed to get recapitalized.
That's great. Very cool.
And it shows how private equity is entering into the shadow banking business and creating a new infrastructure.
Indeed. Yeah, well, I think it's key to note, using a segue, my largest competitors were First Republic and Signature Bank on the respective coast, West and East Coast. And those folks, because of Basel III and quantitative tightening, are no longer lending. And so if anything, the tailwind in the industry is the aperture is widened for bankable sponsors needing private debt that has speed, certainty, counterparty size and exposure. A lot of the regional banks cap out at $10, $15, $20 million in counterparty exposure, where we have products that go to $100, $150 million at each individual counterparty. So I think some of the differentiators that are necessary in the market certainly is certainty of capital, number one, and timing, especially given where things are at today, where profitability is squeezed with interest rate production. Capital plays a really, really important part in sponsors' profitability.
Absolutely. So let's talk a little bit about that shift. You were just speaking about Signature Bank and First Republic Bank. And, we've seen the local and regional banks try to get back in the market recently. And I say try. So tell me, what are you guys seeing out there? Who's your real competition? Are you guys seeing that as well, that existing banks are trying to enter your space and are unable to, or what's your real competition today?
I think it's a combination. I see the banks attempting again, but certainty of capital from the banks is difficult. It's all about whatever that monthly or quarterly meetings are from a credit committee perspective of what they can actually provide in time and scale. So I think it's really dicey. They are trying to get back into market, but again, I think they're restrictive to the capital treatment to those business lines. In fact, many banks have just pivoted out of construction in general because the capital treatment to the bank on construction financing is not accretive at the end of the day. So I think what they're doing is they'll provide some debt at the end of the day to known customers that have high depository relationships. That's part of the benefit of private debt, is that we don't require any depository relationships. Right. So if you can deliver value, even if you're slightly higher in price, folks are willing to pay for it because of short-term interest, again, certainty of capital, no depository requirements, and we're able to do things like relieve some of the guarantee structures at the end of the day on the repayment side, and all of that. It generally plays well with the sponsors willing to pay us maybe 150 basis points wide of what regional banks are providing. And in addition, we can provide more proceeds. So it's a pretty good package from a proceeds
providing more
proceeds. Where leverage drives real return.
Yeah. And no deposits. I mean, with the banks coming out of that Signature and First Republic situation now, asking for deposits, we've heard sometimes 10%, 20% of the loan amount and a relationship, and how many of these are you going to build, and they're looking for repeat customers. We see them just being effective on apartment construction only.
Yeah, basically
they become just
and we've seen them kind of reach a little bit on some portfolios. Like we're doing a pretty large portfolio of lots, finished lots, stuff like that there's a lot of collateral diversity, it's a large deal, something like that. But so Robert, in terms of kind of narrowing down the food groups here, what exactly are you guys looking at Ascent? I mean, I know that, Obviously, it's residential, but let's dig into that a little bit. I mean, are you doing multifamily loans or construct? Like, just tell us what you're up to.
Yeah, it's a good question. So three main business lines. So multifamily value add ground up construction on a national basis. Loan sizes range from small balance multifamily, $2 to $5 million to $50 million loans. Different flavors of multifamily. We do adult active. We do some manufacturing. We do the standard regular way multifamily, whether it be value add or ground up construction. Where we're seeing a lot of the deals don't pencil today, unfortunately, but where we're seeing some green shoots is around the country. It's very interesting. If you look at density here in ED1 combination, some light tech, we do a lot of the bridge leading to the light tech. We do some of the land aggregation that leads to the light tech. In DC, for example, there's tax abatements and density bonus plays that folks can use to be able to allow those deals on an untrended basis to pencil. And so we do a lot of that around the country where the municipalities are providing some benefits back to the operators that allow those deals to pencil to raise equity against. So we find that a lot of different areas like that: Oregon, Washington, D.C., a lot of ADU opportunity here in California. We're doing a bunch of standard regular way, sponsored borrower buys a 15-unit performing building and then puts 15 ADUs on the building at the end of the day.
Yeah.
So we're able to take those out, do the construction. But in addition, because I have 5 and 10-year product in the backside, at the end of the day, some of those folks want to aggregate prior to going to agency. And so I'm able to put if they aggregate 6 buildings and they're all $5 million, I can put a $30 million transitional bridge in place once construction is completed to allow them at a lower cost to lease those up. And then obviously they'll go to an agency takeout generally after that.
With those transitional bridge loans, are you guys waiving some of the interim fees to encourage that?
Yeah, and I try to keep them under the same multiple advance set of docs. So a lot of our loans go from a bridge loan until they're ready to issue on permits or entitlement. Then I do the vertical piece in a second advance, and then I offer the transitional bridge piece in that same set of loan docs as multiple advances at the borrower's option, so that it reduces the friction cost on repaying off a mortgage, paying a new mortgage, repaying tax stamps. Depending on where in the country, it can be really meaningful. So that's one of the products that we held, is we call it a one-time close product in general, and that works really well. Saves borrowers money, and frankly, it gives me a higher capture rate if I'm able to provide the value at the right terms throughout the duration, of the loan.
That's a great product.
Well, that's multifamily side. On the home builder side, I would say it's my second business line, and we operate nationally, both build to rent, build for sale at the end of the day. So those are incredibly important products. As you probably well know, the build to rent, a lot of folks raise a lot of capital around it 2-3 years ago. A lot of those deals don't pencil circa 2025. And so I'm seeing a lot of those products pivot to for sale. And we've been in for sale production home building for a long time on the finance side. And again, I think those transitional bridge products work really well. On my for rent, I'll give you an example of a deal we're funding. We're funding a $56 million deal in Salt Lake City here in 2 weeks at the end of the day. And the loan is comprised of the bridge and the horizontal side of the loan first. The vertical loan comes second in a second advance. The third advance, again, is a transitional bridge where it's leased up. So it's a 220 home community, whereas they phase off the leased up components 60 at a time. They can move from a cost from a construction loan based on a final permit during lease up down to a 3 to 330 over transitional bridge. So if you just look at the total yield cost to the sponsor, blending a standard construction rate loan with a transitional bridge, we really end up about a point above prime at the end of the day. So it's very competitive with the banks on the guarantee structure. That's an example of our for rent. And then for sale has been in our DNA. We build infrastructure for sale, and we do that around the country all the time. And on the same side of for sale, we'll move to a for sale option on a bridge versus a for rent lease up option, on whether it's multifamily single platted or it's individual platted on the sellout.
Yeah, interesting. So why don't we talk a little bit about your portfolio construction and kind of risk management? You guys are obviously trying to originate a huge volume of loans, both in number and in total dollars. What do you think allows you to do that? You've spoken a little bit about your team, but are you making other investments internally to help, scale the business quickly like that, but yet make good portfolio management decisions?
Well, first it starts with the capital markets. So let's start with there first. So having the right balance sheet that believes in your vision to grow a company over time and scale to build opco premium at the end of the day is the key. And then having that balance sheet allows you to have the right lenders behind at the end of the day. Today we have $1 billion in warehouse lines behind that, and we're securitizing as of Q3 this year. So having both the balance sheet, the national warehouse lenders, in addition to the securitization options, are critical to be able to deliver value back to the sponsors in the form of price, flexibility, size of loans. So I think that's gating item number one. So assuming that's all in place, as Ascent has, then portfolio management, being able to build the right credit community at the end of the day and governance. We have a very specific data strategy where I onboard all the national tax data, all the MLS data, all the permit data around the country. It's expensive, but I've been doing that for the last 12, 15 years, making heavy investments into onshore, offshore, taking that data at the end of the day and utilizing it to manage it portfolios. Meaning, once we manage our portfolio, my portfolio, for example, manages at about a 50% construction rate. So if I have $2 billion in outstanding loans, I can have $1 billion in construction loans on the vertical side. That's what I manage to as a portfolio. But within those buckets, I also manage to early stage construction risk, mid stage construction risk, late stage. So even within that 50%, I'm always managing my early stage risk against my late stage completed properties, because most of my assets are cross collateralized if they're within the same equity stack. And there's other credit mitigants to be able to manage the portfolio. But having all that data at my fingers, as my counterparters are taking data, anytime they file a deed of trust, I can see it. And so I think one of the risks in our business in general, especially around the private lending community, is that other lenders do not underwrite contingent liability or global cash flow as we do. And so when they don't, where people get in trouble is they take too much high priced debt and they get over their skis, and that's where they get in trouble. So frequently it's not your deal or your loan that causes the issues. It's the fact that your borrower has loans that have gone over their skis on taking other loans outside. Having the visibility into that transparency helps us to manage that risk. And that's a key risk mitigant.
And I have a question, are you seeing most of the development in the Sun Belt states? Are you seeing, we often hear that, New England or Minnesota or other places have been neglected so long that there's huge, needs there, and that maybe Phoenix is overbuilt. What's your take on kind of Sun Belt versus other?
I think it depends
the
on
smile states?
My third line of business, let me answer the first and I'll answer your question. My third business line is just scatter lot construction around the country, including luxury single family infill. And that happens in areas, as you can imagine, like Los Angeles, up and down the coast, Seattle, Washington, D.C., and up and down the coast of Florida, where there's no land and it's just infill. And folks have to actually tear down those homes, build new. We facilitate a lot of that debt. So back to your question is, okay, where is the opportunity upcoming? I see each business line have different opportunity. As I just mentioned in the scatter lot sites, anywhere where land's restricted with old housing inventory, it's 1960s or less. All those homes have to be repositioned, torn down, and built new. So that's where our opportunity is in scatter lot. In my home builder, definitely the smile states, where at the end of the day, the numbers pencil, where you can actually make a rental pencil in areas where you have communities of homes that are $400,000 or $500,000 in value, but can still generate a rental income that makes sense to hold for rent based on permanent financing. And then the multifamily, I think, as I mentioned, I think it's really, today it's very tight, obviously, but it's really market by market. Like the ADU opportunity is a perfect thing in California, where we have this ADU opportunity, we have ED1 opportunity. In other areas, you have some of these abatements that have come back in Brooklyn or some of these density bonuses in areas like DC. And I think it's really spotty. But when you find the niches that the deals will pencil and the operators have the expertise, more importantly, to take advantage of those opportunities, that's where I think you find it. But it's not as easy. And that's hunting and pecking around the country. You mentioned Minnesota. A lot of people don't know that if you just look at single family transactions, buy and sell by an entity within a 18-month period of time, it's number 3 in the country behind Dallas. A little known fact. I know that because I spent $1 million with McKinsey to tell me that fact, believe it or not, 4 years ago. But so there's pockets of opportunity everywhere, depending on what business line and what asset class you're talking about. I'm seeing more conversion. I'm doing conversions on small office space to residential. I'm doing that on the East Coast in Connecticut,
Oh,
in
interesting.
Maine. I'm doing that in DC. I'm seeing anywhere where these small office buildings,
Yeah.
at the end of the day,
Mhm.
obviously do not work as office space any longer, and the community needs the tax revenue. So it's a win. And so I'm seeing a lot of entitlement opportunity moving to the residential space in those offices.
Interesting. Yeah, those smaller floor plates are just about the only thing that
Yeah.
works
That's
for
it. The bigger
conversion.
ones are really difficult. The smaller
They
And
really
they're often well located too.
Yeah.
Right off the
Where
freeway.
people want to be.
Where people want to be.
Yeah.
Interesting.
So, hey, Robert, you've been a successful leader in the industry for a long time. And because of that, you've seen a ton of people come and go, both probably competitors and also sponsors and developers. Obviously, the real estate development business is not for the faint of heart. So, what kind of advice could you give some people that maybe are newer to the space of real estate development? What kind of wisdom can you impart on some of our listeners here?
I think number one is the numbers on the paper are easy to look at and easy to digest. But when you're penciling your numbers to a profitability number on a project, always know that the worst case not scenario is that you don't meet those numbers. Worst case scenario, and I've been in this situation myself, unfortunately, on the equity side, is that you actually could lose meaningful dollars, not just make the 15 or 20% gain, but
Mhm.
at the end, because I what I found with myself and with others, being overly optimistic about the political view, the rate curve environment, I think is a trap sometimes, and I think a lot of folks, especially the
Right.
earlier guys, get in that trap.
Trying to game it.
So, and I think that's the problem. I think the most important thing I would impart to anybody, especially early stage investors, is to really sensitize your models all the way to your losses to find out what it really takes to not only monitor what your profitability is, but what your loss could be based on a
Mhm.
myriad of different variables, i.e., construction budget costs, your interest costs, if you're floating, where floating rates could go. I think everybody still is in the camp that rates are going to come down. I can tell you that on a national basis, at the end of the day, I'm talking to my partners, my old partners that I was there 2 weeks ago, and they're viewing 2026 as rate increase, not decrease. At the end of the day, those things are really important because when you're sitting on floating rate debt, a lot of people don't pencil in the fact that your spreads can widen at the end of the day and cost more. And I think that's been a lot of the problem on the multifamily side of these small balance multifamily operators. We're sitting on floating rate debt, for periods of time, and then have trouble writing a check to get out of the debt.
And having trouble buying the cap, etc. Well, that's a good segue maybe to some. I have two uh, present situation questions for you. One is, of course, we have to ask about tariffs and how do you see that affecting costs? And then the second question, which is, a little bit related and maybe unrelated, is I saw today on CNBC a spectacular segment on a 3D printed SFR development in Texas. And the Lennar vice president was saying that he's going to cut costs by 40% on the next one and double the size, and it's hyper efficient, and it's also very interesting is completely fireproof because it's printed with no lumber at all. And I just thought it was interesting. So those are my two questions.
I'll answer the tariffs first. Everybody's concerned with a myriad of different things: labor costs,
Mm-hmm.
obviously,
With
inflationary costs with the tariffs. I don't think we've seen the actual impact yet. We're concerned about what the impact's going to be. For example, to me,
right,
is that our sites across the country, people are still on site working. At the end of the day, there haven't been a site where we've got to the site and half the workforce is gone. So
right.
yes, I think caution is the right play because I think everybody is concerned and we don't know enough about this is going to happen yet. Do I think that we're going to see some near term inflation? Yes. Do I think costs are going to go up? Yes. So that question is how much? We don't know, and I don't know. But I think that again, back to sensitizing materials, labor costs.
Right.
At the end of the day, and making sure you're widening your budgets at the end of the day, especially on contingency, I think is critical.
Right.
TBD. I think we got to keep a close eye on it, and we'll see what happens to how much you need to sensitize and widen those contingencies. I'm not sure of the answer to that yet. That's how I feel about tariffs. On the on the on the 3D printing, it's fun. It's very interesting timing for that, because I also just looked at a no lumber, company that was producing SFRs, not on 3D print. They're actually on cement pouring and tilts with no
Right.
lumber. And we just spent, a good part of a month. And given the timing with the fires here
Right.
in the Palisades, et cetera, it's a very interesting time, because there's not just cost impact, there's insurance impact. If you have a non-flammable impact property, you're certainly, number one, you will get insured. Number two, it's likely going to be some level cheaper at the end of the day. Who knows?
Especially if you're
20%
surrounded by like
Well,
properties.
I think that my view is that there's going to be a path for a lot of this modernization of how you actually build and materials of it. It has to be. And I think it makes a lot of sense. And I think we're early days. And I know that Lennar, I did read some about that. And now they've made some investments for a long time there. So, we always hear this and then see it actually, move in. But listen, we've watched manufacturing housing grow and grow at the end of the day. And we plan on lending on the manufacturing housing side as well, because we think it's got to a point where we can get our arms around it at the construction. So I hope that there becomes more and more alternatives to straight lumber construction for all the reasons we discussed.
I think one of the keys there, though, is the consumer, right?
Yeah.
Is the consumer ready to live in whatever? So,
It's
design.
This particular model that was not by Lennar, that one of the other benefits was in these non-lumber homes, that assuming you could get the finishes right and it looked and felt like a regular home, the temperature, there's no variation in temperature throughout.
Right. It's like living in a cave.
Within 3 to 4 or 5 degrees, which is another interesting thing. If you get into
lumber really holds
110 degrees in Phoenix, or in the wintertime, it's 25 degrees in Buffalo, right?
Right. That's amazing.
Yeah.
Well, Robert, I'd just like to say thank you, for spending a little bit of time with us. I think, folks out there would really appreciate listening to what you have to say. So we appreciate you doing that. Where can people find out more about your business?
Well,
where do they go to?
First, I'm going to give you guys a plug. Number one, I've been doing business with George Smith Partners for a very long time. You guys have a fantastic brand. So it's my pleasure to be on GSP. I think you guys, again, continue to drive that brand, and we look forward to doing more business. So I think one area is through GSP itself, right, to get to Ascent. And then the other area specifically is our website, and our, at the end of the day, you can always get onto my website. And what I plan on doing with GSP in particular is sharing our information, or in our senior account execs. But I think the main differentiator for us is we're small enough and we're dealing with large enough sponsors to where I'm generally not writing a loan. I'm generally solving for a $30 to $100 million exposure on an annual basis. What that means and why that's important is that every business we deal with, there's a CEO of their development business. And I think that CEOs need to be able to talk to a decision maker and a senior exec in the team. And so our business is built around small business lending, where we're lending to small businesses, and they're able to talk and discuss things, whether it's a construction lead, a top of the house, myself, or other senior exec rep that's a partner in the company. And so we're going to provide you guys all that information to make sure those folks can get in touch with the right people at Ascent.
That's great. We appreciate that.
Thank you.
Thank you for joining. Just for our listeners out there, sign up for FinFacts at gspartners.com/FinFacts. Thank you so much.
Thanks everyone.
Guys. Appreciate it.
Okay.